Well, hello and welcome to this webinar, French Banks Head into a More Volatile Business Environment, brought to you by Scope Ratings, with me, Keith Mullin, as moderator and quizmaster, and Nicolas Hardy, Scope's Deputy Head of Financial Institutions.
Good afternoon.
Now, as the French banks get ready to post their Q1 results, we thought it'd be useful to offer some broad perspectives now on where we are and where we might be heading. For example, might slowing or stalling economic growth in France herald a more difficult period for French banks? And were the lackluster Q4 results a one-off anomaly or perhaps more harbingers of what's to come? So to take us through these themes, rather than a formal presentation, we thought we'd do a bit of back and forth, interactive back and forth between Nicolas and myself, with some questions to some slides that Nicolas has prepared earlier. We'd also be delighted to take your questions, so please do type these into the questions tab on the platform and we'll incorporate them into the discussion. Now, the slides that you'll see today will be made available at the end of the session, and I'll tell you how to do that later. We'll also make available Nicolas' recent French Banks Quarterly, which was published earlier in April. So let's get started. So Nicolas, it's great to be with you again. I hope the weather in Paris is better than the gloomy weather in London. So let's get to the first slide, and let's have a look here. Here we go.
Thank you, Keith. Yes, indeed, we have very nice weather today, and earnings season is about to start. So nice to have this refresher where we landed year 2023 and what we expect for 2024, sort of updated views at the moment. So what was quite interesting at when French banks published their full year result, announced full year result in February, was to see the sort of contrast between decent earnings throughout the year 2023 overall, and as a rating agency, we do care for resilient earnings and the ability of banks' business model through the cycle to provide resilient earnings. And I would say on average, we had this confirmation looking at the full year figures on the left hand side of the screen. However, on the right, the quarterly figures were maybe for investors, and we've seen that also in the equity market. The quarterly performance was maybe for some more puzzling and below expectation. So the question at that time, and still very valid, was it just a quarterly issue or the emergence of a new trend, given that after now a dozen of months with financial tightening, high interest rate, and all the effort to slow down inflation at EU level, expectedly, I think the economy, the macroeconomic performance, not only in France but across Europe, was in some cases really pointing to a slowdown. So how that would translate for the banking sector and in particular loan production, fees and commission activities, etc. So that was really at the end of the quarter, the key question, and that we continue to look at.
Okay, yes, indeed. Now, one of the key contributors to all banks' results, I wanted to come to, if I could, Nicolas, net interest margins, because this slide that you're showing here on the chart on the right, showing how net interest margins play out in some key European economies and in the EU. You see France really bumbling along the bottom. And it strikes me that the French banks have followed a kind of fairly unique pattern amongst European banks. And they're clearly showing some of the lowest NIMs in Europe. Can you perhaps start to focus on that first of all? Why is that? And perhaps some of the factors leading up to that. And I guess let me ask my second question as well, so you can think about it as you're speaking, is what can the banks do, if anything, to overcome this, particularly in the domestic market?
Yeah, thanks, Keith. Indeed, the chart on the right from the EBA risk dashboard is something we look at with a lot of interest. It's really striking to see how flat the net interest margin has remained for banking operation in France for a very long period of time. We have had the low for long interest rate period, and the increase of interest rate was supposed to be a new era for banks. We can see that in terms of interest revenue generation, that was the case in many countries, but not in France, and that was really puzzling. At the same time, you could say that French banks managed really to have interest rate management very well managed, because at the end of the day, that's the purpose of interest rate management. Hedging strategies is to compensate for any volatility in interest revenue. So you could say they've been performing very well on that front, really delivering. But surprisingly, I would say, compared to many other banks, they did not reap the benefit of rising rates. So it's always a trade-off between maybe um, risk management and better return. And in the case of French banks, that's something which is very visible looking at the NIM. So we know why it happened, because of structural feature in France. We know that we have most of the mortgage, the bulk of the mortgage loans are at fixed rates. So the only occasion for a bank to reprice the mortgage loan is whenever they grant a new loan. Basically, there was this very long period of renegotiations when rates went down, and of course, this is not something that clients are keen to renegotiate, of course, and so the repricing of the book of mortgage portfolios is very slow in France. And there are some statistics about that, but the average duration on mortgage loans in France, I heard about something like 7 years, just to show how slow the repricing of the book can be. At the same time, we have in France this specificity, the regulated saving, the livret A, which are indexed to inflation with a certain formula that has been adjusted, and the rate to be served by bank to client has been fixed at 3% for a longer period now. So there is less volatility, more visibility for banks in terms of managing on the liability side, but it took some time for assets to reprice at a decent level to compensate for the more rapid repricing on the liability side. And we can see in the middle the sort of missed opportunity for French banks compared to, for instance, Spanish or Italian banks. We have more variable rates, loans at variable rates in Spain and Italy. So the difference between, for instance, in Italy, the blue line and the red line, which is for French banks, you can nearly calculates the missed revenue, the gap between the two, between French banks and Italian banks. So, and there will be no catch up in a sense. Now we have this convergence of rates. But the key question now is also about volumes. So how banks can cope with that? That was your second question. What is very important when we look at the credit worthiness of French banks is the size of their balance sheet, the fact that the French market is already well consolidated. We have large players with sound financial metrics and very diversified business model. We have bancassurance, which is a source of fees and commission. In retail, the products and services are well integrated. We have seen many initiatives also in the mobility sector, sort of trying to replicate what is going on with housing, with cars, mobility, leasing, selling insurance product also. So there is a fully integrated value chain this, and French banks are able to benefit from that. So the focus was not in the past, and still is not really on maximizing rates on mortgage loans. It's about servicing clients with a really diversified product suite. And this is how we've seen that first slide, how they've managed, despite this pressure on net interest margin, still to have decent earnings.
Yeah, actually, before we can we just perhaps go back, Nicolas, just one more question, if I may. Just on this, on the left-hand slide, you talk here about interest rates on loans finally catching up with rates on deposits, which were obviously previously moving more quickly. And I think you may have already mentioned this, but there's a timing. I had a question about timing because we've now sort of got to this sort of perhaps a more normalized situation just when we've potentially reached peak policy rates, and so if we have slow growth and rates coming down, I mean, does this change the scenario at all in terms of the impact on the banks?
Yeah. So indeed, we can imagine that with higher rates, the appetite from borrowers for loans can slow down, and I won't say that was the intention, but to fight again in inflation, the slowdown of the economy also results in a lower loan production by design. So that's yes, that's the challenge, and something also I move also to the next slide to illustrate this also, where we are in terms of loan production and what to expect. We can see that that's the chart on the right hand side. It's plateauing for some, or even reducing for some, I would say, asset classes or loan types. So yes, indeed, the key issue for French banks, and I can again come back here, is that we have higher rates, but probably going forward, lower volumes of production. And again, I mentioned that, but in the past, the low for long interest rate environment, French banks were very active on the volume side, compensating for the low interest rate. And we believe that it's going to be increasingly difficult with the slowdown of the macroeconomic performance. It's going to be increasingly difficult for banks to compensate, thanks to rates that are anyway going down slightly already, and that could be in anticipation of rate cuts later this year, but also I think really tough competition in the market among banks to grant loans to customers that are still looking for loans. So I won't say scarcity of opportunity to lend. We are not yet there in France, but less demand for loans and rates going down. So it's really not ideal indeed in terms of timing. And again, I can only say that, yeah, there will be, for this reason, no catch up in France. Maybe French banks will be late and have improving net interest margin now in 2024 compared to all the other European countries, but probably also some pressure on loan generation. So at the end, we don't think that profitability is going to improve materially in 2024. In terms of loan pickup, in the mortgage segment, January, February, very low production. Apparently March, we've seen some pickup. Is it because rates were slowly adjusting a bit lower, so we've had more appetite in the market? It remains to be seen if the trend is confirmed, but rates are still at quite a high level, and the anticipated policy rate cuts are more for the second half of the year.
Right.
Okay,
so let's just quickly. So we talked so far about the net interest margins and some of the deposit loan issues. I wanted to ask you about how you see French banks' cost management in the current environment, and whether that can be a way of perhaps boosting profitability. And second, I guess the same question the other way around is, I mean, obviously, expenditures are expenditures, but at the end of the day, some expenditures are being taken on now in order to basically create benefits tomorrow. So can you talk about cost generally and about the destination of costs, and whether there's any comfort around future benefits?
Yeah, thanks, Keith. And sorry again for this glitch. So yeah, the cost issue for French banks is it used to be really a focus on how improving the operational efficiency of business model. And with pressure on net interest income, I think the topic has not disappeared at all. On the contrary, across the EU, we've seen many banks managing down their cost-to-income ratio. I would say closer to even sometimes 40%, and on average close to 50%. And for French bank, it's a bit striking to see that it has even deteriorated further. So we have a sort of new starting point in terms of cost to income, which is high. For BPC and Société Générale, the reported figures were above 70%. In Europe, we have also Deutsche Bank with a similar level of cost to income, and so all the effort are put on improving those figures. And for instance, Société Générale has communicated on a plan, a multi-year plan with an expectation of a linear improvement of the cost-to-income ratio. So indeed, banks are working actively on this issue, addressing the cost-based issue. They've managed so far to it's not really on the wage side that we see pressure, because many banks have managed to grow the expense based on track or lower than inflation. So it's not there. Maybe we have some specificities like in Belgium, where wages are indexed to inflation, but it's not the case elsewhere in Europe in general. So the pressure is on earning generation and how to improve the business model. So French banks have diversified business models. They are all working on various strategic initiatives. I mentioned mobility, for instance, which is a very important driver for BNP Paribas, but also for Société Générale, with the merger of ALD and LeasePlan. So it's by indeed investing in those strategic initiatives and also adjusting the business perimeter that banks expect to make progress on that. We have seen also adjustment of the geographical footprints for some banks. Again, Société Générale, for instance, revisiting its presence in Africa. It's relatively modest in terms of importance compared to the rest of the group, but still there are various initiatives, and banks are looking at that proactively. So from a rating perspective also, this is very important. Yes, cost to income ratio above 70%, this is very high, and it does not compare favorably compared to peers. But we see that banks are actively launching initiatives to bring that down over time.
Okay, great. And if we perhaps I don't know if there's anything else on this slide you wanted us to talk to.
Yeah,
otherwise, we can yeah. The next one here, I think that asset quality is the big bête noire. So that's my best French of banks, and in previous cycles it's been a real problem. So yeah, I mean you're showing some interesting some data points here. What would your kind of best guess be on the cost of risk outlook, and provisioning policies, given where we are with some of these asset quality factors?
Yeah. So that's maybe indeed the next important topic. We are revenue generation, we have the cost base, and if we go down in the P&L, now we are looking at cost of risk. And why it matters, because if there is pressure on cost to income, if there is pressure on revenue generation, French banks do not need pressure also stemming from higher provisioning requirements. And the good news here is that so far, there is no such pressure, and banks so far have communicated on cost of risk guidance that are really in line with their through the cycle average. So we don't see at the moment really pressure, material pressure in terms of provisioning requirements. But this is really something we look at very carefully. And the few important indicators that are leading us to be very cautious on that. So first, we have this slowdown of GDP growth. Um, we know there is no direct correlation between NPL formation and macroeconomic performance, but still, it's something very important to monitor. We know that unemployment is only marginally deteriorating in France, and that's also very important for consumer loans, for mortgage loans, and also as an indicator of the wealth of the corporate sector. And in terms of corporate bankruptcies, we are expecting this gradual normalization after COVID. And during, no need to expand on that, but all the support measure resulted in unexpected diverging trends there. And now we are at the level of the historical average. The thing is that it's very unlikely that it's going to stabilize at this level. So we are at a sort of high point in terms of what we would expect in France. It's if the trend continue, that would probably put some pressure on French banks' asset quality. And just to characterize what happened recently in France, we've seen this modest increase of asset quality pressure, but very moderate, in line with medium-term targets. At the same time, we have seen some large corporates into troubles in the IT, in the retail segment, also retailers, in the health also sector, and those are visible in the consolidated figures. But there is no broad issue that banks now need to address across sectors. There is a decent level of granularity there. So we are not worried at the moment, but it needs to be really monitored very carefully, because very likely we'll have a time lag between the expected rebound and 2024, around the second half of 2024 and 2025, if this scenario materialize, and the possibility that NPL continue to increase moderately in France. So there will be this time lag also between the two, but rate cuts also we are going to help on that front.
Okay. Actually, there is a question about the rating pressure on France's sovereign rating. To our questioner, I'm afraid we can't address that on this session, but I will actually make sure you get the copy of our latest rating report on the French sovereign. But Nicolas, just I guess on the previous slide, you had a table on stage 2 and stage 3. Before we move on, do you have any particular concerns about the classification evolution?
No. So what we have seen across Europe, sometimes stage 2 moving up, stage 2 loans that are a sort of watch category moving up, but banks were often explaining and that it was due to reclassification and alignment of definitions. And this is what we've observed with BPC. And there is no, I would say, dramatic changes observed so far. On average, it's improving. Maybe here and there, banks may be cautious on certain portfolios, but there is no general deterioration in terms of, I would say, watch list at the moment. And also we have this heat map on NPL ratios across the 10 largest EU economies. You can see that France is relatively well positioned. I would say the evolution of NPL ratios is relatively benign in recent times, so still at very low level. So
Yeah.
yeah. And
Yeah.
on the right-hand side, you have this slide where we break down the absolute amount of NPL increase over the last quarter. This is a very interesting data set that we have thanks to the work of the European Banking Authority. And the split in France, we can see that even the household, the stock of NPL reduced there. It was really mainly the corporates who generated, and at the margin, I would say, the increase of NPL in France, and relatively benign total amounts.
Indeed. Now, it would be a great time, Nicolas, if you wanted to perhaps put a little advert in for the forthcoming heat map publication.
Yeah, so it's just a sort of surveillance tool that we will publish very soon. It's this heat map with some comments highlighting the key trends that we observe, leveraging on the set of data published by DB. So forthcoming publication, it's based on public information, but by combining the data and presenting them that way, I think we can add value to help investors also monitoring NPL development across Europe.
Yeah, absolutely. I think the first one is scheduled to be out as soon as tomorrow, but that's hopefully that'll be the case. Now, capital clearly a very topical factor when it comes to banks, particularly with all this talk about the Basel Endgame, Basel IV, etc., etc., etc. Now, European banks, and I think you and your colleagues in the banks team have been consistently talking about the French, but European banks are pretty well capitalized. But when it comes to the French banks, how comfortable are you with their capital positions?
Yeah, on that front, we don't have really worries. Maybe I can mention upfront that there is maybe one area that we monitor a bit more closely is how banks, listed banks, are managing their leverage ratios, which is more tightly managed than other large listed European banks. So it's something to watch how banks are adjusting. I think BNP and Société Générale, they have large balance sheets. In absolute amount, the excess of a minimum requirement in terms of leverage ratio, it's significant. And also they have the ability, thanks to the characteristics of their balance sheets, to adjust the size and mechanistically to reduce the leverage ratios. So they are tightly managed, but tightly managed, but proactively looked at by the market and adjusted by banks. So something to monitor. But other than that, in terms of capital policies, I think we have on average solid average core capital metrics. We don't see volatility there, which is also very reassuring. Banks have still the ability to invest in bolt-on acquisition, and here I'm not only referring to BNP Paribas, which intends to reinvest the proceeds of Bank of the West. Recently, we've seen Société Générale and BPC communicating on the sale of Société Générale Equipment Finance to BPC, which is a good sign. It shows a dynamic management of business perimeters and the fact that banks are able to make those business changes whenever required. That was an interesting add-on for BPC, given their room in terms of asset risk intensity. And interesting for Société Générale in the context of the ongoing restructuring. And we have seen this also recently, Crédit Agricole announcing the acquisition of Degroof Petercam to strengthen the wealth management proposition. So things really, banks are quite active, and it's a sign that they are in good shape. And it's also a confirmation that regulators view positively at the moment their capital position. And whenever a bank announces a share buyback, given that it's first agreed with regulators, we also see a sign that even in the context of the Basel implementation, and that was your question, banks have still the flexibility, room to maneuver to make use of their capital. So the time horizon for Basel, there are expected impact in 2025. There are measures that benefit from grandfathering. We don't expect major surprise at the moment. Banks have enough organic capital. Organic capital generation is sufficient also to help them to maintain the ratios at the level, at their current level. So capital is not for us an area of attention, only because in our rating methodology, we are focused on how banks are managing excess buffer above minimum regulatory requirements, that we look individually at those ratios, and we have a particular attention to leverage ratios. But other than that, we don't see major signs of concern there.
Okay, Nicola, just got a question coming from one of our viewers actually, and I'll just read it. Do you expect the French banks will hold more capital following the countercyclical capital buffer increase to 1% as of 2nd of January 2024, or will they decrease their buffer above the minimum reserve requirements? It's got a specific question, and feel free to, perhaps we can circle back to our questioner if you don't have the an immediate response.
No, I think we don't expect always a mechanistic increase of the total capital buffer whenever there are conservative regulatory measures that are implemented. And yes, we focus on distance to regulatory requirements in our rating approach. At the same time, when we see that there are counter-cyclical measures that are implemented, and I would like to refer here to Norway, for instance, where the regulatory requirements are very high for banks. We take that into account, and we believe that it's okay to have a thinner buffer above regulatory requirement when it's already very demanding. So not an issue for us. I think we would acknowledge efforts if banks were to maybe increase the overall capital level, but less than what a regulatory measure would impose on banks on a relative basis. Yeah.
Okay, if you don't mind, I wanted to perhaps ask a question about the funding side. And if you look at the capital market activity in the first quarter, in fact, year to date, French banks have been very active up and down the capital and funding structure. And so they clearly have good market access. And so on the funding side, I say, I mean, TLTRO is kind of done, it's over. Customers are looking for yield. How do you see the French banks adapting?
Yeah, so end of TLTRO, that's something that was massive. Still, we are at the very end of this phase. Banks have still residual portion to reimburse. I think it's very important to keep in mind that the end of TLTRO, we are used to rollover of those refinancing operations, and the end of TLTRO means really down to zero. And that was so a massive reduction of liquidity in the market. What is really interesting and really demonstrates the ability of French bank to adjust is that we haven't seen any balance sheet contraction, which could have been liability driven. With the end of TLTRO, the reimbursement of TLTRO, we could have also expected a sort of downsizing of balance sheet and reducing loan books. Banks were able to access the wholesale market very actively. We see that always there is a seasonality during the first quarter of the year. It's even back to January in general. It's like a safe haven for banks to issue. So very active this year again, diversified access to the various debt instrument also. So that's a positive sign also, confidence in the market. In terms of funding also, French banks rely a lot on customer deposit. And so far, the overall envelope of customer deposit remained quite stable. And what was interesting there was the migration between on-demand, non-remunerated deposits and time saving accounts that yes are putting pressure on French banks' net interest margin. But from a funding perspective, we've seen that the customers were quite sticky, and this is a very important characteristics for funding. If we all remember what happened to the US regional banks last year. So stability of deposit, also it's an area of attention, and banks are on the safe side on that front. So positive development in terms of funding and liquidity, like for capital, not really an area of concern for us.
Yeah. Okay. Perhaps talking of developments in this particular case, perhaps not so positive. Away from the funding liquidity, if I may, I'm just conscious we're putting to draw our session to a close in a few minutes. But last week or week before, we had a session on commercial real estate when the focus was on the real estate corporates and on the German banks. I think it would be useful if you could give us some perspectives on French banks' commercial real estate exposure, whether that's in France or generally on the balance sheet. Is this something that's actually on your radar, and do you have any particular concerns?
Yeah, so commercial real estate remains an important topic, and we've had, I think, regulatory warnings for quarters and quarters. And with the tightening financial conditions, we've seen risks materializing in this sector, not that much in France. We know what happened, Germany, Austria, and that was a major contribution to the increase of NPLs that we've observed in recent quarters, in especially those two countries. So it's not really the case in France. We are looking at the signals we get from market dynamics in the real estate segment, not only retail but also commercial, indeed, commercial real estate. And I would say at the moment we have mixed signals. And what is important here is to really notice that French banks have very diversified exposure to commercial real estate by asset class, by geographies. And so there are concerns about idiosyncratic issues in Austria, impacting also German banks. There are concerns about the performance of the real estate in the US, also in China. Not that much really so far in France. So the dynamism of the construction sector is of course something we look at. The bankruptcy figures, for instance, in those two sectors, real estate activities and construction, are higher than the average for the entire corporate sector. So it's something to monitor. The size of the sector real estate activities for French banks is in line with the European average. We don't see major concentration here compared to peers. Construction exposure to the construction sector also, it's meaningful in terms of absolute amount, but again, we have granularity. And I would say diverging trends maybe also from one market to another within France. So there are regular focuses on area around Paris, for instance, in the real estate sector. offices, how do does the office sector perform, and we are getting mixed signals there, but not it's not bullish at all, of course, at the moment, but there is no sign that really lead us to believe that it's a major area of attention for French banks, and signals that it could put pressure on their creditworthiness anytime soon.
Perfect. Okay. Well, let's end on a bit of an up note. Unless you have anything you wanted to say, Nicolas, I suggest we close the session. Just a reminder, if you wanted to download the slide presentation and or the French Bank Quarterly, click on apps at the bottom, handouts, and then you'll see 2 PDF downloads. So Nicolas, I guess you'll be watching with interest how the Q1 results come out in the next few days and weeks.
Absolutely, yeah.
And so we'll circle back at some point in the future with another session like this. And so let's close it there. I wish you a very successful rest of day, and we'll be back soon. Okay, so it's goodbye from us.
Thank you very much.